Hello, welcome back to the Trading with Ashley show. Really excited about this video because the first video I did was all about selling puts on SoFi stock. Well, now that the stock price has risen, it's time to sell covered calls. And this is exciting because when you put both of these strategies together, you are running the wheel strategy. And this is how I make consistent income day after day, week after week, month after month, year after year. If you follow this process, you can usually make about a 30% annualized return on your money, but you must follow the rules and you must be conservative and not greedy if you're going to run this strategy. So what we're going to do today, I'm going to take you into the computer and I'm going to show you what price I acquired my SoFi shares at. We're going to look at the right strike price to sell covered calls, and then we're going to look at the return so that you can get a better sense for how lucrative this can be. But before we go too much further, I do want to make mention of a wonderful strategy that's a little bit different that I am going to be hosting a workshop on with one of my very good friends who is incredible at trading and technical analysis. His name is Stocks with Josh, and together we are hosting a skips call option workshop. What is a skips? A skips is simply a purchased call that is about 3 to 9 months out. Now, doing a call that is 3 to 9 months out actually makes it a little bit safer, and this is a great strategy for smaller accounts if you don't have enough capital to actually sell puts like I just showed you in the earlier video. So I think you're going to be really interested in this, and I can't wait to personally meet you and show you everything I know about skips and leaps call options. I have a real brief video to show you, and then you can sign up with the link below. What if one workshop could change the way you trade forever? Josh and I are hosting a live 2-hour workshop where I'll be teaching you all things skips. A smarter, lower risk option strategy I actually developed and trademarked to help you grow your portfolio without gambling.
And I'll be diving into charting mastery from indicators that work to how to spot trend reversals before they happen.
It's all happening Saturday, May the 31st at 6 p.m. EST, and spots are limited.
Click the link below to secure your spot and thank us later when you turn your trades into a Wall Street ATM.
Trust us, your future self will thank you. All right, now we're heading into the computer to complete this trade on SoFi stock. The first thing we're going to do is we are going to go check on that original trade we made when we sold the SoFi put at $12.50. Now here is the exact trade. It was June the 20th right here. This was the expiration date. Now what has happened since we've made this trade is that SoFi has continued to increase in price. So it is getting further away from our strike price, and our strike price was $12.50. Well, here's what happens when it moves away from the strike price. You see right here, we received 54 cents, so $54 for the 100 shares. We have one contract. Well, now you can see that this same contract is only worth 37 cents, so $37. And here's the difference. So if we were to buy this contract back right now, we would be able to hold on to $17 of the original 54 we received. Now, there's no reason to go ahead and do that at this point. We'll allow the trade to continue to play out because one of two things will happen. It will continue to move up, or even if it stays where it is, as long as it doesn't breach our $12.50 on expiration date, then we get to hold on to 100% of this 54, because that which cost $37 to buy back now will cost $0 once time decay takes place. The other option is to leave the trade alone, and if it does pull back to $12.50 or a little bit lower, we just leave it alone, and then we take assignment of the shares at the $12.50 mark. So this just shows you where we are on that particular trade. Now, I had done an earlier trade, and I actually have the shares. I had received them around this strike price. So now we're going to look at the other side of the equation, what it looks like to go ahead and sell a covered call on shares that you already own. But before we do that, we want to take a quick peek at our technicals because this is our roadmap for where we should look at a potential strike price. So if you're looking at SoFi today, it checks the first box. And the first box is it a green day? And today, yes, it was a green day. We ended the day at almost 1340. So that's good, okay? So that tells us this is going to be the more profitable time to sell a covered call. But now I'm sure you're wondering, what strike price do I want for my call away? Well, that's where we look at these Bollinger Bands. This gives a predictive potential move for SoFi, and it's not an exact science. Sometimes it goes higher, sometimes it goes lower. But if you want the best shot at a fair call away, then you want to shoot for the top of the band. So the top of the band is right here at about 1429. So what we'll do is look for something around 14 or 1450. They don't actually offer anything at exactly 1429. So we'll look at what is close, and then we will see how much premium we will receive if we sell a covered call, meaning we'll give up our SoFi shares that we actually got lower than now. And we'll give them up at the strike price of either 14 or 1450, and we're going to get paid a premium for that. So now let's go back to the option chain and look at what we will be paid if we agree to give up those shares. Now, just to show you my exact trade, on April the 8th, I actually acquired these shares at the 1237 mark. So this will be helpful to know this when we look at the total return on all of our activity with this stock. The sold put, the sold call, and then the call away, the price appreciation. We're going to put all those together to get our return on this trade. This trade was done on the Fidelity platform, but I'm going to go back to Robinhood so that you can see exactly how it looks in the same account that we sold the put on. Now, just to be clear, to do this trade in this platform, you would have to own 100 shares. You could have purchased those shares outright, or you could have been assigned the shares after you sold your put and the expiration date has come to pass and you were put the shares. Either of those scenarios would allow you to then go and sell covered calls. The first thing I want to do is go to Trade SoFi Options. After you populate sell call, then you have to select an expiration date. Now, I personally only like going out 1 or 2 weeks max because I don't want to wait until this trade plays out. If I'm in it a month or 2 months long, then I'm basically holding my money hostage from doing other plays. So for that reason, I like to go out only a week or 2, but several like to sell monthly options. So for this example, we're going to try to stay consistent, and I'm going to look at an option that is around that June 20th date, like we did the initial trade. Once I select June 20th, now I want to go look at my various strike prices. So right here, the $14 strike, we saw that that was a potential. It's paying 49 cents a share, so that would be $49. But here, the $14.50 strike price is going to only pay me $35, but it does allow for an additional 50 cents in stock appreciation. So I would prefer to err on the side of additional stock appreciation because that's going to be another $50. And I would add that $50 to this $35 for the total call away price. It may take a little bit longer to do that, but there's not a huge enough difference between the 49 and the 35 that I wouldn't want to go for the higher call away price. Because one of the best parts of the wheel strategy is after you have the call away happen, then you go back to selling puts when the stock pulls down and you rinse and repeat this process. And that's how you gain so much money over a year's time doing this over and over again. To illustrate this, I am now back in the Fidelity platform because I actually have the shares in Fidelity. We still have that open position on SoFi on the sold put, but my shares actually reside in Fidelity. So here's what it would look like on that ticket. You have sell to open. This is a call. There's my expiration date. This is the strike I selected, $14.50. And then my order's right here, my limit order for 35 cents. And then I made it good for the day. So if this were to execute, then I would receive the $35 and I get to keep that regardless of what happens. And then as this trade continues to play out, if we get to our expiration date and SoFi is trading anywhere at $14.50 or higher, then my shares will be called away. I'll get to enjoy all that stock appreciation plus all the premium I received on both ends of the trade. Now, let's look at the total return, and I think you're going to be impressed and understand why this is such a lucrative way to trade. If we acquired those shares on April the 8th at $12.37, and then they were called away on June the 20th at $14.50, that's $2.13 price appreciation. But keep in mind, on the sold put, we did receive a premium of $54. And on the sold call, we received a premium of $35. So when you add all of this together, you are looking at a profit of $302 on all of the activities surrounding SoFi. When you look at that to get the return, you take 302, you divide it by how much capital it took to actually make that money. In this scenario, it's $1,237 because you're looking at the 1237 multiplied by 100. That equals 0.244. If you multiply that by 100, now you're looking at a 24% return in just 2.5 months. Now, that's pretty impressive for a return because if you just have your money in the SPY, which a lot of people do, a lot of hedge funds, investors put their money just in blended funds, you will receive a return of anywhere between 8% and 12% per year. In this particular trade, you got 24% in just a couple of months. Now, as a beginner, you should have everything you need to start operating the wheel strategy. And once your confidence grows and you do this over and over again, you should start considering venturing out to other ticker symbols. Keeping in mind, you should always look for profitable companies that have a bright future because the main thing when you're running the wheel strategy is you do not want to be afraid of assignment. Now, as you grow your portfolio and you have more money to work with, consider starting a longer term portfolio that is a buy and hold, and you can start to use some of the proceeds that you are generating from the wheel strategy to establish your longer term positions. Remember, if you're with me trading with Ashley, there is no trader left behind. Now, if you want to put all of this together, I am going to link the video that I did on SoFi puts, and you can watch that video right here.